Hey, hello investors and future investors. Welcome back to the channel. My name is Tim, and on this channel, I show you how I make weekly income from trading and investing. Now, my portfolio is split into three different categories. The first category is going to be dividend stocks, and this part of the portfolio I like to call the long-term investments. The second part of my portfolio consists of cash secured puts, covered calls, LEAPS option, and this part of my portfolio I like to call the midterm strategy. Now, the last part of my portfolio, this part of the portfolio is what I refer to as the Get It Now portfolio, and this part consists of option spreads. So for this video, I'm going to be using one of the strategies from my midterm portfolio, and that's known as LEAPS options. Now, LEAP option is a very powerful strategy that magnifies your income. Now, LEAP stands for long-term equity anticipation securities. Now, I know it's a mouthful, but here's a fun fact. If you do have one contract, it's known as a LEAPS. If you have several contracts, it's still known as a LEAPS. Now, enough of that, let's get right into it. So you guys know how we do it. I always say you need to get down and dirty with options. So I always show you exactly what I'm doing. So for today's video, we're going to be using stock Chipotle ticker CMG. So here we are on Chipotle. So I'm going to let you know the format of this video. The number one thing, I'm going to demonstrate to you how to put on a LEAPS option. The number two thing I'm going to do, I'm going to show you the LEAP option I do have in my portfolio. And lastly, I'm going to show you how to use this LEAP option in order for you to generate weekly income. Now, before we start, I'd really appreciate it if you guys were to like the video, subscribe to the channel, and please hit the notification bell. This will allow you to get a notification whenever I post a new video. Now, let's get into it. So, in order for you to do a LEAPS option, you need to go into Trade CMG options. Okay, so once again, LEAP stands for Long-Term Equity Anticipation Securities. The L stands for long-term, so obviously we need to choose an expiration date way out. The E is going to stand for equities, so you either use an ETF or a stock. Now the AP in conjunction stands for anticipation, means that you're expecting something in the near future. So let's go ahead and firstly, we're going to make sure it says buy on call, and we're going to choose our strike date. So the strike date I'm going to be using for this video is going to be June 20th, 2025, and that gives us 338 days to expiration. Now, in order for you to maximize your gain and mitigate your risk, it is highly suggested that you choose your strike price below the current share price. Now, as you can see, Chipotle is currently trading at 55.22 right here. So we're going to go ahead and we're going to choose a strike price below this share price right here. Now, if I were to buy 100 shares of Chipotle right now, I would have to pay $55.23, which is going to equal to $5,522. As you well know, each option contract is multiplied by 100 shares. Now I'm going to go down, I'm going to choose the $50 call. Now, as you can see, I already have one in my portfolio. I always practice what I preach. So we're going to go ahead, we're going to open that in order for me to explain to you the Greeks and why is it I decided to choose this particular strike price. So in order for me to get the $50 strike price, I'm going to have to pay $12.10, which is going to equal to, in option terms, $1,210. That's going to allow me to control 100 shares of Chipotle. Now, it is a huge difference between $1,200 and $5,500. And I'm going to show you where this is going to come in handy in a bit later. So this is how I decide which strike price I'm going to choose. Number one has to do with affordability. It must be a price what I could afford with my portfolio. Number two is going to be the delta. Whenever I buy a LEAPS option, I always like to choose a delta of 0.75 or higher. Now, as of making this video, the delta has decreased just a bit, but based on your own personal preference, you can determine what delta you are going to go with your Greek. The other reason I use to choose my strike price is going to be the open interest as compared to the volume. The volume here is just 1 and the open interest is 1204. Now, if you're not familiar with the Greeks, I have an entire video of how to learn the Greeks and how to use it to trade. The last thing I look for in order to select my perfect strike price is going to be the implied volatility. So we're going to go ahead and we're going to click the $50 strike price. And as you can see here, I will have to pay $11.80. Now, what other criteria do I use in order for me to pick the correct strike price? Or even more than that, how do I determine which stock I want to use? Well, I'm going to give you another free resource in which helps me decide. So we're going to go over to a website which I love using, and that's going to be stockcharts.com. Now, this is a free resource which anyone can use. So once I type in my ticker symbol, CMG, the chart is going to open up. Now, bear in mind, the first chart you're going to get is going to be a daily chart, and I'm going to show you how to switch this up in just a second. Now, based off the daily chart, you can see that Chipotle is literally trading at a 32 RSI. So let me tell you what RSI stands for. RSI stands for Relative Strength Index, and it's an indicator that tells you whether stock is overbought or oversold. Now, anything between 50 and 70 RSI means that the stock is going into overbought territory. Now, any price between 50 going towards 30 tells you that that stock or ETF is being oversold. Now, I personally love to pick up these stocks at an RSI between 30 and 50. But if I have a choice, I would get it way closer to 30. Now, on the daily update chart, you can see the RSI is 32. Now we're going to switch over to the weekly and see if that compares and if it hits my criteria. Okay, so here we are on the weekly chart, and as you can see on the weekly chart, the RSI is still below 50 and it's between 30. So this is a perfect time for me to pick up this LEAPS option as it hits my criteria. So now we're going to go ahead and go back to the CMG option change. Now that is just one resource I use in order for me to pick up a LEAPS option. Feel free to use any resource that works for you. Now, LEAPS option play a major part in my portfolio. Now, the reason for this is that I do not mind acquiring stocks that are oversold and then waiting for them to appreciate in value. Another LEAP option that I actually have in my portfolio right now is going to be XPeng, ticker XPEV. Okay, so here we are on the XPEV LEAPS option, and I can show you guys that I do currently have 3 in my portfolio. Now, I did pick this up, I think, on July 9th or July 8th. Here it is, on July 8th. As of making this video, which is going to be July 17th, the returns on this contract is already up $275. Now, am I going to exercise this contract? No, I would not. The reason I'm not going to exercise this contract is like I always say on the channel, before you enter any option contract, always make sure you have an exit strategy. My exit strategy for this LEAPS option is to sell at any point when the strike price goes over $9.50. So a few tricks before you buy a LEAPS option. Always make sure you have an exit strategy, and this also goes for any type of option contract you're entering into. Another tip is going to be always try to pick up a LEAPS option in a stock or ETF that has been oversold, so you reduce your risk of the trade going against you. So now that I've picked up one LEAPS option on Chipotle, what are we going to do? Remember, I use this option strategy in order for me to make weekly income. So let's go back to Chipotle. So once you have acquired one LEAPS option into your portfolio, now I'm going to go ahead and I'm going to show you how I make weekly revenue on that LEAP option. Now, in order for me to do this, I have to add another strategy, which is none other than the covered call strategy. With the covered call strategy, I'm going to be using my LEAPS option as a hedge against making weekly income. So let's go ahead. I'm going to show you how to do it. Now, I'm not going to go too much into detail because I do have lots of videos on the covered call strategy. I will link it in the description below. So let's go ahead now to trade CMG options. Let's make sure it says sell and call. So now, as opposed to the long strike date, which we picked up the LEAPS option, now we're going to be choosing closer strike dates only a week out. So we are in the week of the 19th, so I'm going to be choosing the week of the 26th. Now, once again, as opposed to the LEAPS option, where we did choose our strike price below the current share price, with the covered call strategy, you're going to want to choose your strike price above the current share price. Now I am going to be going with the $60 strike price. As you can see, I already sold one covered call right here. Now with that $60 strike price, I will be paid 80 cents or $80. Now the reason why I chose the $60 strike price is two major reasons. Number one is going to be my chance of profitability. My chance of profitability based on my own risk tolerance is I really like a chance of profitability always once I'm trading covered calls of an 80% chance or higher. Remember, when purchasing my LEAPS option, I look for a delta of 75 and above. However, when I'm doing covered calls, I like a chance of profitability of 80% or higher. Now, with this 80% chance or higher, I'm going to be receiving $80 on a weekly basis. So, come expiration date, July 26, what's going to happen? Well, if the share price remains below $60 strike price, I get to retain my $80 and I get to do this trade again for the following week just rinse, repeat, and just keep generating money. However, if come expiration date, July 26th, and the share price is now above our $60 strike price, then what can we do? Well, that's when we go into a different option strategy, which is going to be called rolling. This allows you to either mitigate your risk or roll out to get additional premium. I will link the video of option rolling in the description below. So let's do a quick recap. LEAPS option is a very powerful option strategy to use in order for you to magnify your gains in your portfolio. The first step is to buy a LEAPS option with a far out expiration date. Any expiration date, 6 months and above, will definitely work for this strategy. The second thing you do, now that you're able to control 100 shares of the underlying stock or ETF, then you're going to turn around and you're going to do weekly covered calls in order for you to generate premium. The third and most important thing, which you should have done before you even purchase the LEAPS, is have an exit strategy. When are you going to sell? When are you going to roll over? And that is the power of having LEAPS option in your portfolio. Now, if you guys can resonate with this kind of content, remember to give me a like below and hit the subscribe button. And remember, please hit the alert bell to get an alert whenever I post a video. And until the next video, remember, always keep pushing your investments.